You know, when a major conflict erupts thousands of miles away, it's pretty easy to just see it as a distant headline, right? Something that doesn't really affect your day-to-day. But in our completely interconnected world, those shockwaves can hit your investment portfolio almost instantly. So how do you navigate that financial fallout? Well, today, we're diving straight into the wealth management playbook for exactly these kinds of geopolitical crises.
And that really is the central question we're tackling. This isn't about trying to predict the conflict itself. That's impossible. It's about understanding the financial mechanics that turn regional instability into a global market event that actually affects your wallet. So let's get into it.
Okay, here's our roadmap for today. First up, we're going to explore why the Middle East has such a massive, outsized impact on the global economy. Then we'll trace the shockwaves of that risk as they ripple through the financial system and see how that actually impacts your assets. After that, we'll open up the playbook that sophisticated investors use to steer through these turbulent waters. And finally, we'll uncover what the real long-term risk actually is, and it might not be what you think.
So first things first, let's just establish the fundamentals here. Why does this one specific region command so much attention from global markets? Well, it really just comes down to a few absolutely critical factors.
Now this slide really lays out the perfect storm. The region doesn't just control a huge chunk of the world's oil, which directly fuels inflation everywhere. It's also home to the world's most vital shipping choke points. I mean, think the Strait of Hormuz, the Red Sea. Then you add in the strategic chess game being played between the US and China, and you've got a situation where any little bit of instability sends investors all over the world scrambling for safety.
So how exactly does that risk travel from a news headline all the way to your portfolio? Well, you can think of it as a series of financial shockwaves or transmission channels that just ripple across the globe. Let's trace how these channels actually work.
And here you can really see that chain reaction laid out. It starts with an energy shock, right? Higher oil prices lead to that sticky, persistent inflation, which then forces central banks to delay any thoughts of cutting interest rates. So in response, capital flees to what are seen as safe havens. We're talking the US dollar, government bonds, and of course gold. This then triggers a volatility spike, which makes markets really jittery. And finally, you get this political fragmentation where the risks of things like sanctions and currency instability start to climb.
Okay, so those are the shockwaves. Now let's get practical and look at the actual fallout. What does all this mean for the assets sitting in your portfolio? Well, the effects are definitely not the same across the board. Some sectors win, and, you guessed it, some lose.
The most obvious impact, of course, is on oil and energy stocks. They often see a pretty big short-term price surge as tensions escalate. But, and this is crucial, you've got to remember these are highly cyclical assets. What goes up on war fears can come crashing right back down just as fast on rumors of peace talks.
Now for the broader stock market, the picture gets a lot more complex. Europe and any oil-importing emerging markets, they get hit the hardest by an energy shock. The US, on the other hand, is generally more insulated. But there is one clear winner in all this, the defense sector, which tends to benefit structurally from all the geopolitical instability and inevitable budget shifts.
You know, bonds are fascinating in this scenario because they're caught in this massive tug of war. On one side, you have the fear of inflation, which pushes bond yields up because investors want higher returns. But on the other side, you have the fear of the conflict itself, which pushes yields down as investors pile into the perceived safety of government debt. The net effect really just depends on which fear is stronger at any given moment.
And then there's gold, the classic safe haven asset. In times of geopolitical crisis, it almost always benefits. It's partly a financial hedge against inflation and currency chaos, and it's also partly just a psychological comfort blanket for nervous investors.
And finally, those illiquid assets, things like real estate and private equity that you can't sell in a day, they really face some headwinds. That combination of sustained high interest rates and general economic uncertainty just makes financing more expensive and finding an exit way more difficult. In this kind of environment, liquidity, or cash, is absolutely king.
Okay, so we've analyzed the problem from just about every angle. Now, let's pivot from theory to action. How do sophisticated, ultra-high net worth investors actually navigate this kind of chaos?
Well, their mindset is completely different. It's not about hitting home runs, it's about not striking out. Their priority stack is crystal clear. Number 1, preserve your capital. Protect what you have. Number 2, maintain liquidity so you're never forced to sell something at a terrible price. And only then, as a distant third, do they look for opportunities to deploy that cash when everyone else is panicking.
And this mindset translates directly into a clear 6-point playbook. First, they raise cash. Then, they spread their assets across different legal jurisdictions, think the US, Switzerland, Singapore, for strategic safety. They add hard assets, like gold and energy, to hedge against inflation. They cut their leverage, because a margin call can destroy a fortune way faster than a war can. They get exposure to sectors like defense. And maybe most importantly, they avoid emotional, panic-driven decisions, because they know that historically, markets do recover.
This brings us to our final and, I think, most important section. We've talked about all the immediate risks and reactions, but what is the biggest, most fundamental threat to your wealth in the long run from all of this?
This quote just absolutely gets to the heart of it. Historically, the greatest damage to people's portfolios isn't caused by the event itself, but by the behavioral mistakes we all make in response to it. Panic selling, getting over-leveraged, and letting our own biases drive investment decisions.
Which leads us to this massive question. If it's not the war itself, what is the single biggest financial risk that comes out of a prolonged crisis like this?
Well, the answer might actually surprise you. It's not the headline risk you see everywhere of oil spiking to $130 a barrel for a few months. That's a temporary shock, and the system can pretty much absorb it. The real danger is something much deeper, much more structural.
The real risk is a permanent shift in the entire global financial landscape, a world where inflation now has a new, higher floor of, say, 4 to 6%, a world where central banks have to keep interest rates elevated pretty much indefinitely to fight it, and a world that's fragmenting into competing economic blocks, which structurally raises the cost of capital for everybody. That kind of shift doesn't just cause a little volatility, it permanently changes the very models used to value every single asset on the planet.
And that leaves all of us with the final, critical question. This isn't just about weathering a temporary storm anymore. It's about recognizing if the climate itself is changing for good. In a world that could be defined by higher inflation and deeper fragmentation, the strategies that worked for the last decade probably won't work for the next. The crucial takeaway here is that you absolutely have to be prepared to adapt.